Imagine this. You've saved $100,000 and you're ready to make it grow. You want to invest wisely, but you don't want to spend all day managing your portfolio. What if you could invest in a simple, low-cost strategy that lets your money work for you over the years? This is where Fidelity Index Funds come in. And today, we're going to explore the top 5 Fidelity Index Funds to invest your $100,000 and how that money can grow over time. First, why index funds? Well, they're designed to give you broad exposure to different parts of the market, whether it's U.S. stocks, international companies, or even bonds. They're low cost and diversify, which means your risk is spread across a large number of companies or sectors. It's a set it and forget it kind of strategy, perfect for long-term growth. So, let's dive into the top 5 Fidelity Index Funds that could help you grow that $100,000. First on the list is the Fidelity 500 Index Fund, or FXAIX. This fund tracks the performance of the S&P 500, which is an index of the 500 largest publicly traded companies in the United States. We're talking about giants like Apple, Amazon, Microsoft, and Google. Investing in this fund means you're putting your money into some of the most successful and stable companies in America. Over the long term, the S&P 500 has historically returned around 7 to 10% annually, making it a cornerstone of any solid portfolio. Next, let's talk about the Fidelity Total Market Index Fund, ticker symbol FSKAX. This fund doesn't just invest in large-cap companies like FXAIX, it covers the entire U.S. stock market. That means you're also getting exposure to mid-sized companies and small-cap stocks. Why is this important? Smaller companies often have higher growth potential, especially in the early stages. And by investing in the total market, you get a piece of that action. It's like buying a little bit of everything. You're diversifying not just across industries, but across different sizes of companies, which can help boost your returns while managing risk. Now, if you're someone who believes technology is the future, you'll want to look at the Fidelity NASDAQ Composite Index Fund, FNCMX. This index fund tracks the NASDAQ Composite Index, which is heavily weighted toward technology companies. This fund gives you exposure to industry leaders like Tesla, Facebook, and Amazon companies that are driving innovation and changing the way we live and work. The tech sector has seen tremendous growth over the last decade, and while it can be more volatile than other sectors, the long-term potential for higher returns is huge. If you believe in the continued rise of tech, FNCMX is a great way to tap into that. Of course, stocks can be volatile, which is why it's smart to balance your portfolio with bonds. Enter the Fidelity U.S. Bond Index Fund, ticker symbol FXNAX. Bonds are typically more stable than stocks and can help reduce the overall volatility in your portfolio. When the stock market goes through rough patches, bonds can provide a cushion, offering steady returns and lower risk. They're not as exciting as stocks, but they play a crucial role in preserving wealth, especially as you get closer to retirement or when you need to protect your investments during economic downturns. Finally, let's not forget about diversification outside the U.S. That's where the Fidelity International Index Fund, FSPSX, comes into play. This fund gives you exposure to companies around the world. Excluding the U.S., think about big multinational companies like Nestle, Toyota, or Samsung. By investing internationally, you can capture growth in other regions, especially emerging markets, where economies are expanding rapidly. International stocks can add another layer of diversification, helping your portfolio grow even when U.S. markets are underperforming. So, how does this work if you invest $100,000? Let's break it down. Imagine you split your money evenly across these 5 index funds, $20,000 in each. Now, let's talk about growth. Historically, the stock market has returned about 7% per year on average, adjusting for inflation. Of course, this can vary from year to year, and some funds may perform better than others in certain years. But over the long term, 7% is a reasonable estimate. If you let that $100,000 sit in these funds for 10 years, at an average return of 7%, your investment would grow to nearly $197,000. You've almost doubled your money by simply letting it grow and compound. Now, if you hold on for 20 years, your $100,000 could grow to around $387,000. That's the beauty of compounding. Your money earns returns, and then those returns earn even more returns. It's like a snowball effect. But let's get even more ambitious. What if you hold your investment for 30 years? In that case, your initial $100,000 could grow to approximately $761,000. That's over 7 times your original investment, all thanks to the power of long-term compounding and smart investing. Of course, the key here is patience. Markets will go up and down in the short term, but if you stay invested and ride out the bumps, history shows that the market tends to trend upward over the long run. The most important thing is time in the market, not trying to time the market. Many people get spooked by market dips and sell off their investments, but the real secret to building wealth is to stay the course.
And here's another important point: fees. One of the biggest advantages of Fidelity Index Funds is their low expense ratios. While actively managed funds might charge 1% or more in fees, many Fidelity Index Funds have expense ratios as low as 0.015%. These low fees mean more of your money stays invested, compounding and growing year after year. Over decades, this can make a massive difference in how much you earn. So, what's the next step for you? Take the time to research these funds and think about how they align with your goals. Whether you have $100,000 to invest or you're starting with a smaller amount, the principles are the same: diversify, keep fees low, and focus on the long term. If you found this video helpful, hit that like button and subscribe for more personal finance and investing tips. Let's build wealth together and take control of our financial futures.